2013 was quite a party for stock markets, but the emerging markets very conspicuously failed to join in. In fact, they've been underperforming the West since 2011. Now, what's interesting about that is that leaves emerging market equity as one of the very few asset classes around the world that actually looks cheap.
We do see value in emerging markets. As a whole, emerging markets are currently trading at price-to-book values which have only been lower during the period of the Asian crisis. We do not think currently that there's a prospect of another Asian crisis or an emerging market crisis, as governments have better funding than they did in 1998 and stronger reserves. To that extent, we think there is reasonable value in emerging markets.
The problem is whether they can be expected to release that value anytime soon. If you want something more to worry about, take a look at commodities, which have been falling as long as emerging market stocks have.
They are cheap, self-evidently, but that doesn't mean they're attractive. And the emerging market performance for the last 15 years has been very much tied into the commodity cycle. Since we believe that commodity prices will continue to trend downwards, I would anticipate that valuation gap continues to open up and emerging markets continue to underperform.
That also fits with a long-term picture which has seen the growth in China's foreign exchange reserves decline as commodity prices have declined. And that, in turn, you could say, fits with the notion that emerging markets as a whole have moved into a secular decline. That leads us to two crucial questions. First, can China manage what looks like a dangerous credit bubble and continue to grow?
We had that big spike in Chaibor and Shibor in the middle of June, and we now see the central bank in China starting to allow those rates to rise once again after the third plenum back in November. And a lot of the shadow financing is being squeezed on that side. So I think there are risks in China of a disappointment to the downside. And the question is how significant that risk is, whether we see some extreme valuations unwind sharply or whether they can manage it in a slow manner. My best guess is someday there'll be a day of reckoning. I suspect they may get away with it for another year.
The other big question, of course, is the Fed. Back in 2013, the mere threat of tapering off QE bond purchases was enough to bring money flowing back into the States and away from those countries that had particularly big current account deficits. People refer to them as the BITs: Brazil, India, Indonesia, Turkey, and South Africa.
Well, those countries, they need a long-term structural reform plan. The FDI that they have is not really stable. It's basically growth driven by hot money. Can't run current account deficits and still grow the way they have. So the question is, do they have enough foreign exchange reserves to manage if there is another taper tantrum? And I think the answer is yes. It's not like 1998.
The prospect of higher interest rates in the future with this tapering conversation has caused some of that money to go back. And that put a heck of a lot of pressure on certain key emerging markets, particularly the ones that are the most dependent on those inflows. Those would be the countries with big current account deficits. There's no doubt in my mind that come tapering time again, they will come under pressure. I suspect it'll be much more orderly.
The tapering process has a long way to go, of course. When the Fed actually started tapering in December, emerging market currencies did fall, but not that drastically and not as much as many had feared. It did look as though tapering was to some extent in the price, but there's still a long way to go.
I think there'll be challenges in emerging markets in the coming year. When the Fed starts tapering, if they start raising rates at the end of next year, I think the great challenges will come in a number of these countries.
That's where the greatest concern must lie. On a 5 or a 10-year basis, yes, emerging markets definitely look cheap, but it's hard to buy them now, given that we know that the mere talk of tapering nearly prompted an emerging markets crisis in 2013. It's difficult to buy into them until we are sure that there will not be a repeat of that in 2014.